on the crypto side, address a question that we've been getting quite frequently. You can tell how convinced we are that deflation is the higher probability. And we know that's way out of consensus, and that's where we like to be. But many wonder how we could be positive at all about Bitcoin. We're not worried about inflation. Well, I think 08-09 is a very good reason why. Why did 08-09 almost melt the financial world down? It did so because of counterparty risk. And what we've just seen in the crypto market is really interesting. It's been cut in half, 2 trillion to 1 trillion, the ecosystem, in the last few months. Just cut in half. Can you imagine what would happen if our equity prices, bond prices were cut in half in the span of a few months with all the leverage out there? I think we'd be in a counterparty risk problem again, a big mess. Maybe not as big of a mess as we were in 08-09 because there have been some changes. But I do not believe that our financial world would withstand a 50% drop as easily as the DeFi world has. DeFi, while a lot of people who were leveraged 100 times elsewhere in the world were wiped out, I think, now I'm going to get this number wrong, it was either 86,000 or 860,000 accounts wiped out. DeFi didn't skip a beat. I don't think we could say that for the traditional financial world. And I do think that's why the shift towards DeFi, helped now by central banks moving into stable coins and legitimizing digital currencies, even though that's very different from Bitcoin. I do think we're going to accelerate further and faster into the DeFi world. And that too is very exciting. And as you know, if Bitcoin's price on a trend basis, remember, we're still a triple since last September. We may have been cut in half, but we were still a triple since last. And if the price continues to move up, what does that mean? That means increased purchasing power, which is what deflation is. So very consistent with our view of the world. Just to talk about a few other disconnects here. We also learned that in May, disposable personal income dropped 2% month to month, again, mostly because of stimulus checks having been sent out, and that's the base against which we're comparing May. And the saving rate dropped to 12.4%. Now, 12.4% is still high by historical standards. Right before the coronavirus, we were at 8%. At the peak, we were in the mid-30s. So we've come a long way, but we could go further down in terms of pulling savings down in order to fund purchases. So we'll see what happens there. Another curious thing we learned was retail inventory. Retail inventory in May. Now, retail is mostly goods. Retail inventory fell 0.8%. And that's after a drop of 1.6% the previous month, while industrial production's going up 0.8%. So that's where kind of the light bulb went on for me. Could it be that the inventories are not going to be at retail stores? They have backed up into the consumers' homes. And that's why consumption might disappoint the retailers going forward. Against, I think, the consensus expectation, the consensus short in terms of currencies was on the dollar at the beginning of this year. And the dollar is not going down. And that's also consistent with the bond yields coming down, surprisingly. Now, it is true that our bonds are offering, even at this low rate, 1.4%, 1.43%. They're offering more than the negative yields elsewhere in the world, Germany and Japan. But that's been true. That's been true for a very long time. So at the margin, that we do not believe has made the difference. What could be making the difference in terms of the dollar going up is this notion that the terms of trade are not going to turn as much against the United States in the form of higher corporate tax rates. And in fact, this 15% minimum tax will hit everyone in the world. Now, it will hit disproportionately some of the very profitable tech companies who have been able to manage taxes globally to very low levels. But that, again, it's true for everyone. So at the margin, maybe that is why the dollar's going up. We've also seen some quite deflationary signals, outright cyclical deflation, which got us thinking about inventory corrections. Lumber prices have been cut by more than half now. Maybe that was lumber that do-it-yourselfers were storing up, seeing the lumber shortage coming, and they're just not in there buying now. That's pretty interesting. In China, pork prices have dropped precipitously. Now, we may not pay too much attention to that price, but that might be the most important price in China in terms of keeping consumers happy. It's a big part of their diet, and the government watches it very carefully. So that's interesting. Copper prices are still down in the 10 to 15% range. So there are some signals out there that perhaps inventories are somewhere in the system, and we're seeing a cyclical unwind here. Oil, as I mentioned earlier, is the outlier. We'll see what happens with the OPEC meeting. As of this recording, I guess they had not come together on any agreement. I know the UAE wants its base adjusted upward before agreeing to a 400,000 barrel increase in supply. We've been wrong on oil prices, but I will say the higher the price goes, the more demand destruction there will be, because there will be an even bigger incentive to go electric. And now onto the markets. As we've said all year long, this bull market has strengthened. It has deflected all kinds of bad news. The doubling in interest rates in the first quarter, the Archegos leverage blow up in the ecosystem, which many thought could cause systemic problems. We've been through tax hike discussions, which sounded pretty onerous in terms of their impact on capital. And we've seen a big correction. We certainly were right in the middle of it in valuations as those interest rates went up in the higher valuation side of the market, particularly if one is looking at valuations as of this year's earnings. So we're very happy at the way the market has performed. It's up double digits, and we've seen now a shift, a rotation back from value as some of these prices have started to unwind, the commodity prices in particular, towards growth. But I think we're going to see toggling back and forth until some of the confusion that I'm discussing here dissipates. What's clear is profit growth right now has been, or is, explosive. I think for the second quarter, at an annual rate, the S&P is annualizing earnings at $220. So that's roughly 20 times really effectively trailing earnings. And if we think earnings are going up, and we do, then the multiple looking forward is moving down into the mid to upper teens. That is good valuation support given the level of interest rates.